Your credit report, think of it as like your financial CVs. The score is the valuation of that report. Difference between the two is understanding that it's always going to be about credit conduct over credit score. The pros are literally options. It just means that you're able to pivot your financial status at any given moment. It plays a massive, massive factor. Same with going to rent a property. You might see this one and think that one is home. If you've got bad credit, the landlord's in a position to say, sorry, I can't trust that you're going to pay me my money on time, so I'm not renting to you. And what people don't appreciate is hard searches show up on your credit report. The more hard searches that you have gives the impression that you are relying or you have a significant need for credit. They certainly make money off people's bad circumstances, even down to car finance. Car finance is one of the ones that defaults the quickest because they're thinking, hold on, wait, this person still hasn't paid back their loan. They're just out here driving their Mercedes, BMW. Let's go get back the car. Everything stays on your credit report for 6 years. I do think 6 years is a long time. However, it's all down to English law. So there is a law within the UK that allows a company 6 years worth of time before CCJs can actually be removed. Not every CCJ is fair. Now the debt might be fair, but the CCJ itself, the county court judgment, you can argue. So the route that you want to go down.
You're not defined by where you come from.
Yeah.
And I think that's a big message that I always want to tell people.
Like you have to be able to be uncomfortable. Like be comfortable with being uncomfortable.
When you grow up in ends, you don't realise it when you're confident, but you have an audacity to do things that ordinarily most people wouldn't be willing to do.
Welcome back to another episode of the podcast. We've got a special guest in the building. I'm your host, Atto. How are you doing today?
I'm good. How are you?
I am very good. Like I said, today is like my most favorite day because I always get to speak to like amazing people like yourself. So I guess what's been new, because I actually checked, right? Like we spoke almost 3 years ago. That's mad.
Is it 3?
Yeah, 2021.
Oh,
Can you
wow.
imagine? Yeah.
Okay. Yeah. Oh my gosh. Yeah, it's been a long time then. Well, to be honest, I'm still finance expert, still working or specializing in insurance. I've insured a lot more people now.
Yeah.
I'm literally on the verge of opening my own brokers.
Love to hear that.
And sort of expanding. So yeah, I'm a chairman for the generator board at University Greenwich.
Okay. Did you go to uni there?
No, I didn't, but they have an entrepreneur. So the generator is they run like an enterprise challenge, and it's for them to be able to, support startups and entrepreneurs. So I'm the chairman of that advisory board. So that's a lot of fun.
That's amazing.
Yeah. And then that's about it. Still a mum.
Yeah.
Still working hard. Yeah, I can't complain.
Amazing. You already answered my next question. I was going to ask, who is Ella for the people that didn't listen to that episode that we did in 2020. I think you were like my top first 11th or 12th up there. Yeah, so you're early alumni of the podcast. So
I'm happy about that.
Yeah. Okay, cool. So let's get right into it, right? So we wanted to talk about credit, right? Because I think credit is a very important thing, but it's not in terms of the conversation. Even in the personal finance space, we don't really talk about it that much, although it's so important. To getting things like a mortgage, getting a good interest rate on a loan, getting great deals on like your credit card. We really don't talk about that. And a lot of people actually utilize it like really effectively. So I wanted to definitely talk about that today. Okay. But let's start with the basics, of course, right?
Okay, cool.
So when we talk about credit, right, what do we actually mean when we say credit?
I think the easiest way, because I think when we talk about credit, it's going to be subjective and contextual for every person differently. So for me, I think the best way that I can explain credit is leveraging or utilizing someone else's money. Essentially.
Okay. I like that.
Yeah, that's essentially what it is. Someone has been able to give you something, you haven't necessarily paid for it yet, or you haven't utilized that money yet, so you're using someone else's money.
Yeah. Okay. I like that. So when we talk about using other people's monies, we're talking obviously mortgage, right? We're borrowing money
from the bank or a lender is giving you money. You've been able to purchase a property.
Okay.
If it's car finance, they've given you the car and then you have to pay back. Their money essentially has been able to purchase a car for you.
Yeah.
And then you're then paying back that money, which is the value of the car. A loan, Most obvious, obviously, that's cash available in your bank account. You then pay it back.
Yeah.
So yeah, essentially it's leveraging, to an extent, leveraging other people's money.
Okay, cool. So obviously the typical ones are mortgages, loans, credit cards. Are there any other things where people would take out credit for something?
There are a lot of things now that are actually done on finance at the end of the day. And I think what people don't appreciate is how much their credit report plays a factor. So credit isn't just, the mortgages, the credit cards, car finance, like we said. Sometimes it can actually be renting your own home. So even though you're not borrowing other people's money, it's still credit plays a factor. Mobile phones, broadband, even utility bills are now showing up on your credit account.
Is it?
Yeah.
That's crazy.
Yeah.
Actually, now that you say that, you're right. Yes,
Yeah.
I do remember seeing that. When did they sneak that in there?
Yeah, it changed. It
Yeah.
changed where now the utility companies, especially Thames Water, who definitely like to get it wrong. I mean, broke people do silly things.
That is funny, right? The company that's put in, like, they put in on our credit report, they can't even manage their money well.
Do you know what I mean? So
That is funny. That is funny. Okay, cool. So obviously, when we talk about, people use it interchangeably, right? Like they talk about the credit score,
Yes.
the credit report, right? I guess what's like the difference between those two things?
So essentially, your credit report is, think of it as like a financial CV. So it's an overview, or not even an overview, it's a detailed account of all of your financial information. So not things like savings, but any bank accounts that you may hold, credit cards, mortgages, rent, utility bills, applications for credit, all of that is contained within exactly that, a report.
Yeah.
The score is the valuation of that report. Now, the difference between the two is understanding that it's always going to be about credit conduct over credit score, because credit score is a universal code. There's different credit referencing agencies. The score will vary between them, but the way in which they value your credit report is exactly the same for both you and I. So if you've got a credit card and I've got a credit card, and by you having a limit, a credit card limit of £5,000, and you get 200 points for getting that, I get 200 points.
Okay.
So the valuation is the same across the board, but your credit conduct is obviously going to be different to mine, because even though we might have identical credit cards, you might have a mortgage, I might not. You might have a mobile phone on credit, I might not. So that's why I say it's always more important to understand credit conduct over credit score.
Okay. So credit card, how do you understand that? What is that?
That's how you manage that information within your credit report. So that's basically how you manage your account. If you've got an overdraft, making sure that you're not sitting within your overdraft for a long period of time. If you're making payments on account for something that you have taken on credit, for example, car finance, making sure those payments are on time. Credit cards, making sure that you don't sit within a balance on your credit card for a long period of time. So all of those things make up your credit conduct and sort of decipher or determine whether you have good credit conduct or bad credit conduct.
Okay.
And it's quite obvious, to be honest. If you don't make payments on time, you miss them, you get defaults, you get CCJs, you make loads of applications, they get declined. All of that's going to be bad credit conduct, and which is then obviously going to implicate and sort of create a low credit score.
Yeah. It's crazy because I feel like people like you were saying, the overdraft thing. I think that's an easy thing to kind of just overdraft.
It's attached with your bank account. Think about it. When we all went to uni, or those who did, the banks were throwing overdrafts at everyone. So
that's what caught me out, the overdraft. 100%. That's how I got a default. I got a default from having an overdraft. I think I've told this story a lot of times, but like from having a default that by having an overdraft, used up the money, wasn't keeping it active. There was
closed the account, but then you still owed. And honestly, the amount of clients that I speak to that have got defaults in that way, just from closing the account.
I was the only one.
Nah.
So it's a common thing.
It is a common thing.
Okay.
Really common thing. You close the account thinking the closure of that account has come to an end, and you think if there is going to be an outstanding balance, chances are there's going to be some sort of conversation as to how you're going to clear that balance. And what not a lot of people appreciate is that upon closure of an account, if there is an outstanding balance, the company is in a position to default you straight away.
That's deep though, man. Like, wait, so why are they not having a conversation with us, or do they try to?
Nah. Come
They
on.
don't try and have a
They're not trying to
conversation.
have that conversation.
Yeah.
I think, it's with all of them, isn't it? They charge an interest rate in order to make money on the money that they've given you. I mean, if everyone was to not pay back their money, then obviously the companies would be in a bad position. But they certainly make money off people's bad circumstances, even down to car finance. Car finance is one of the ones that defaults the quickest. But it's because they're in a position to come back and take come and take the car back. So it varies from account to account. You can have a mobile phone bill, really and truly, it's data. So they can go 8-9 months worth of missed payments before they'll then put you into default and be like, right, we're not giving you this account, or we've cut off your minutes, so to speak, or whatever. Car finance, it might be 2 or 3 because they're thinking, hold on, wait, this person still hasn't paid back their loan. They're just out here driving their Mercedes, BMW. Let's go get back the car, because the value of that car, remember, the interest is always going to make the value that you're paying back bigger than the item that you originally took in the first place. So chances are they're always going to be made whole.
Okay. It's mad that you say that about cars, because I didn't really think about it that way, because actually you're right, like the value goes down. So if they're not getting their money, let's just get our money quick.
Get the car back, sell it on, and then we've been made whole,
That's... We're going to talk about like how you can definitely a little bit later on, like how you can kind of prevent that, and like how you can kind of, let me not say change it, but if there are ways to, because I'm sure a lot of people are thinking like, okay, I made a mistake. Like I'm sure your clients, right?
Yeah.
Similar mistake to me,
100%.
Very easily done, right? Like made a mistake of opening an overdraft account, living in it, not using it for whatever, and then they get default. Kind of sucks, to be fair.
Yeah.
Like, it's not great. Okay, so you mentioned something else actually about like you've got different credit reports, credit scores. Can you talk a little bit about that?
Yeah, so there's 3 main credit referencing agencies in the UK. That is Experian, Equifax, and TransUnion. So they will all hold the majority of your financial information, but not every single company provides their information to all of the agencies. So it can be a case where Experian has information on your, like I said, your utility account, but Equifax doesn't, for example. Now, they all have a different rating. So, for example, Experian being the most common and everyone wants it, the 999 score, meaning that you've got perfect credit. So, like I said, the information varies across the 3 of them in what they hold. The score can be different across the 3 of them, but essentially it's the same thing. The purpose of it is the same thing, rating or valuing that information contained within your credit report. What I say to anyone, the best place that they want to check their credit is a platform called Check My File, because Check My File holds all 3 credit referencing agencies in one space. So rather than you having to go to Experian, go to Equifax, go to TransUnion, you can just go to one place and get all of your information at once. And therefore you know exactly who holds what, who holds it where, and etc. And there's nothing that you can miss.
Okay, that's calm. So with that, I'm thinking, obviously, if you've got 3 different reports and you've been bad on one, the other 2 is like, is it safe to say, okay, you've kind of almost got 3 chances.
No.
You get one.
Nah.
I tried it, I tried to finesse it, but it wasn't working. Okay, so what happens
Because the variation of information is going to be minimal. So like I said, it's going to be a case where, yes, if you've got a bad account with Thames Water, for example, a utility bill, and that's not shown with Equifax, then absolutely Equifax can hold a better score than Experian or TransUnion, for example. That's fine for the score. However, if you now go to apply for credit, you need to know who that lender is going to use in terms of credit referencing agency when it comes to checking your report. So whilst you're thinking you're all good with Equifax, what if you then go to apply for a credit card and that credit card company checks your report with Experian where you're bad? So that's why I say
there's no way to find out, right?
It's not that there's not a way.
Okay.
It just depends on who does the financial underwriting. So for example, most of the time with lenders, mortgage lenders as well, quite commonly what I've noticed, because I'm not a mortgage broker, but I prep my clients to be mortgage ready. 9 times out of 10, the mortgages tend to use Equifax. However, if it's car finance, for example, then you want to check who the car finance is underwritten by. So, for example, if you're going to buy an Audi, chances are the finance is going to be with Volkswagen. Volkswagen then potentially may use Experian. So you can find out, you just got to ask the right sort of pertinent questions to be able to get that information. I would say it's much easier to just have better credit.
It just is better. It's easier not to finesse. Yeah,
There you go.
Yeah, I shouldn't be trying to encourage people. I'm just saying because obviously, right, like people make mistakes.
100%.
And the default CCJs, right?
Yeah.
That's a mistake that it's like having this black mark on you, and they put it on there for a while.
6
Like you
years.
get punished. Like it's a little. To me, it's a bit not. It's kind of a bit unjust.
I do
because
think
6
6
years
years
is mad.
I do think 6 years is a long time. However, it's all down to English law. So there is a law within the UK that allows a company 6 years worth of time before they can no longer basically come after you for a debt. So it's called statute of limitations.
Okay.
So essentially what that means is, say, for example, I owe you money. You've got 6 years to recover your debt. If 6 years pass, you can still ask me for the money back, but you can't now take me to court to claim that money back. So that is why everything stays on your credit report for 6 years, because if you enter into a financial relationship with a company and then obviously don't pay back that money, they've got 6 years.
Ah, okay.
So the 6 years makes sense.
Yeah.
Agreed. I think it is a long time.
Yeah.
But the 6 years makes sense from that
Okay.
perspective. Yeah.
But they won't. Okay, so let's say if we flip that
Yeah.
and you end up paying, they're not taking it off your early, are they?
No. So information, they will update it as being satisfied.
Okay.
So that can work in your favor to some extent.
Right. Okay.
But the 6 years, in terms of the reporting of the information on your credit report, it's 6 years from when you open the account that they report and continue to do so. And then it's 6 years upon closure on your account.
Yeah.
Closure being either you closed it or they closed it
Okay.
with a default.
Okay. Cool.
So that's where the 6 years comes from.
Mad. I wish
Yeah.
they could do this with student loan, man. Why don't we have it? Why don't we have that?
Don't get me
that
started
shit
on that one.
with student loan.
Don't get
it's
me
30
started.
years, 6.
That's what I'm saying. It's definitely not 6 on that one.
That is funny. So obviously you mentioned check my file. There's a
Yeah.
cost to that though, is there?
Yeah,
Like, how
check
much
my
it
file is
normally?
$14.99.
That's not bad.
So it's not bad if you think about the paid subscriptions. Like Equifax is about $7.99. Experian have got all the features now. They've got like credit boost, and they can
Yeah.
increase your points, you know, based on because you know obviously we're in open banking now, so a lot of the times companies can just take your account number and your sort code, go into your bank account and see
Really?
your transactional history. Yeah, a lot of car finance actually works on that basis now.
Okay.
Mortgage companies, they will do it like that as well. So rather than you sending over 6 months or 3 months worth of bank statements, just give them the account number and sort code and they can actually manually go in there. I don't know how comfortable I feel about that, but
Yeah, like giving your data to these guys. 'Cause
Yeah,
what they really doing with it?
that's the thing, and you have to read the small print. You will think, oh, they're just reviewing the data for this finite period. No, it says in there, for example, we can review this information for the next 9 months. But people aren't checking the small print, so
Because of credit, everybody wants good credit. They want to get the nice house. They want to get the
there
nice.
you go. And you're thinking, well, if I
cars.
don't do this, then I'm
Yeah.
not going to get this, and this is really more
Yeah.
important than me just ticking yes on this box. But
Mad.
yeah, most of the time, if you say no, then they will
Yeah.
accept your bank statements. And from a personal perspective, I think that's a more comfortable way to go about things.
That's crazy. Okay, so let's talk about like some of the benefits and consequences, obviously, of having like good credit, because
Okay.
obviously we kind of, I think people refer to it as credit worthy person.
Okay,
Is that
yeah.
what it is?
Yeah,
A credit worthy
credit-worthy,
person, somebody
yeah.
that has good credit. Is that?
Yeah,
more or
I think
less,
that's it's definitely a common term that I've heard.
Yeah.
I think it's a bit unfair because the reality is that credit worthy
Yeah.
implies that someone's not.
Yes.
And these days, actually, you can get a lot of things even with
is
bad
true.
credit.
That is
I don't suggest it
Yeah.
because in the long run, financially,
Yeah.
the time, and obviously, like I said, credit is subjective. So you have to take into consideration people's circumstances. But I think sometimes the time it can take to actually allow your credit to repair can be more cost effective than going, for example, down the route of obtaining something with bad credit and then a significantly high interest rate, or if it's a property, having a significantly higher interest rate or having to put down a greater deposit or things like that. And also the options available to you are more limited. You know, if it's car finance, if you're credit worthy, you got the options of HP or PCP, hire purchase or personal contract plan. If you don't have bad credit, then chances are they're only going to offer you the HP. And that might not make sense to you.
Yeah.
You know, it might not meet your needs or it might not meet your circumstances. So that's why I always encourage people to definitely go down the route of providing I've got the best credit possible for my circumstances, then go for what you need to go for, rather than thinking, there's lenders out here that will give me a mortgage, even though I've got bad credit, I've got defaults. And yes, there are. But in the long run, is it really that cost effective? You getting it now or just waiting a little bit longer? But like I said, credit is subjective. Who am I to say?
Okay, so let's delve a bit deeper into that. Pros wise, if you have good credit, let me not even say worthy, because thanks for like saying that, because actually you're right, like worthy doesn't sound great. But let's say good credit, right?
Yeah.
So assuming you have good credit, right? You have a good credit score, and you say your conduct is good, right?
Yes.
I like that. I think that's a better term, right? So what are the pros of having, good credit and good conduct, would you say?
The pros are literally options, I would say. It just means that you're able to pivot your financial status at any given moment.
Okay.
So if we think about it, an overdraft, means that if in an emergency there is a big deduction from your bank account for whatever reason, there's money still available. Means that direct debits aren't bouncing and X, Y, and Z. If it's credit cards, of course, all of the points that are available when it comes to credit cards. So there are a lot of reward cards that people can take advantage of, aside from your traditional credit card, which is, here you go, here's £500, spend the £500.
That's a basic one.
Pay it back to us. Exactly.
Yeah.
Basic credit card. So so essentially it's just the options available to you. But again, it's things like going to rent a home. They will now do a credit check if you go to rent. For example, even people who live within council properties or...
Council now?
Yeah, what's the word that I'm looking for? Housing association.
Okay.
They are now in a position to report the rental payments onto your credit report.
They've finally done it.
So again, it can have an impact in the long run.
Okay.
Even down to things like Klarna. Again, it's options available to you. Now, whilst obviously there's no sort of affordability assessment when it comes to Klarna, at the end of the day, that's still something that's now finally, after all of the laws and etc., that's now something that's reported on your credit report. So there's so much that gets reported on your credit report that people don't realize, whether you're actively applying for credit or not. People will think, pay, buy now, pay later, pay in 30 days or split it in 3 payments. People will take that for granted and think, that's not even me applying for credit. Or you walk into a shop and they're like, hey, we've got 0% finance. You're thinking 0% finance, that's just me paying in installments. I'm not taking any credit. No, that is still updated on your credit report. But it's an option available to you. That might make sense.
Yeah.
If someone says that you need some technology for your podcast and you can have 0% finance, and you're thinking, do I want to spend £1,000 up front now? Or I can actually, pay in installments £33 a month. £33 a month may make more sense, especially when they're not adding on any interest. But it's a new account. It's a new application on your credit report. Yeah. That's something that a mortgage lender is going to take into consideration. And because it's a debt that you owe, it's actually going to reduce your affordability when it comes to that mortgage. But people aren't planning out for the long game. So it's definitely pros. It's definitely just options available to you and being able to pivot your financial status at any time. Yeah.
It's crazy because as you were, listing out the pros, it dawned on me that actually when you have good credit, like you say, you definitely have the flexibility, but everything, not all the time, but things have become cheaper for you.
Yeah.
Like you say, so for instance, like you were mentioning, kit for the podcast, me, if I had great credit, maybe I'd pay no interest versus somebody who has bad credit, them having to pay more for the same
100%
thing that I did.
For the exact same thing. Yeah.
Right?
Exact same thing. Same with property, same with the car.
Yeah.
Same with, mobile phone deals, etc. If you've got bad credit, they might say, okay, well, we can give you this option, but you got to pay a bigger deposit. And then this is what your monthly amount's going to be.
Yeah.
So it plays a massive, massive factor. Crazy. Same with going to rent a property. You might see this one and think that one is home. But if you've got bad credit, the landlord's in a position to say, sorry, I can't trust that you're going to pay me my money on time. So I'm not renting to you. And then you're having to force to go with this one. And that one just might be more expensive.
That's crazy. Even the Klarna thing is so mad because that one is, I have my feelings about Klarna. I'm not gonna, everybody's entitled to do what they're doing.
Yeah.
But it's interesting that because that's making credit more accessible than it's ever been before.
100%. And
right? Because it's like that, right? You can even have it as a checkout option without having, do you even go through like, do you do anything apart from just put your normal details?
No, because there's no affordability
That's
when
what I
it comes
thought, yeah.
to no affordability
That's
assessment when it comes to
crazy.
Klarna whatsoever. So they had to fight to get Klarna to now start reporting the information to credit referencing agencies.
Yeah.
Because of course people were just taking out, getting things on Klarna,
Yeah.
not paying it back, and then wondering why they're now in like financially dire situation. So they finally started reporting it to the credit referencing agencies. But again, now they're fighting for the affordability assessment. Because if you think about it, if you've got someone that is barely making ends meet, what are you doing on Klarna buying something to pay them back in 30 days? Your situation today is going to be the same in 30 days. So what are you doing?
Yeah.
So
Crazy.
yeah, I'm the same. I think there's pros and cons of Klarna, but again,
It's people's choices. I'm not here. Look,
Yeah,
if you're
it's not about judgment.
exactly, if you're
Yeah.
financially astute and you've got your process to using it,
Yeah.
perfect. If you're not and you're kind of using it as a mechanism where you can't really afford anything,
To pay for things, yeah,
that's where it's a
100%.
bit mad. Like
Definitely.
you're literally living on like roulette type of thing.
100%.
You know what I mean?
Just
Yeah.
gambling when that 30 days is going to be up, thinking,
Exactly.
oh, am I going to have the money? Am I not?
So obviously, you mentioned actually that there's that when you do a credit check, right? They what they call it, hard search, right? That's what it's
so that's
called,
an
right?
application.
Talk a little bit about that. What is that, and how does that have like an impact on your your report?
So you've got something which it's still, I would say, quite a new thing, which is why there's all that terminology between hard check, soft search, hard search, etc. But essentially a soft search is where you're almost like being pre-approved. So that's where you're entering in some information, and based on that information and based on a small amount of access to your credit report, can't immediately see any defaults or CCJs, you're likely to be approved. Now, a hard search essentially is an application. That's an application for credit. Now, for example, if it's something like a mortgage, you might have got like a decision in principle, and they may have said, right, we're going to give you the home based on you paying this amount of deposit at this interest rate with these monthly payments. We're now going to go for a search on your credit report to make sure there's no other information that we need to sort of factor in based on this deal. Mortgages obviously are subject to further underwriting. So there might be some other things going on where they're like, nah, we need to change the deal. But essentially that's what the search is based on. Same with car finance, same with a mobile phone, whatever it is, broadband. Like I said, that is them doing an application. So is your credit conduct, does it stack up to basically the offer that we've given you?
Yeah. Okay.
So that's essentially what a hard search is. What people don't appreciate is hard searches show up on your credit report. The more hard searches that you have gives the impression that you are relying or you have a significant need for credit. And especially if you're being declined, remember with a credit report, there's no speech box where you can, there's no explanation or X, Y, and Z that you can add in. There's no little text box where you can say, hey, was just messing around here, wasn't actually applying for anything. There's none of that. So if you're a lender and you're seeing search, like 5 different searches all within the space of say 4 to 6 weeks, they're going to be thinking, what is going on while you're so desperate for credit? And also I can't see any new accounts. So none of these accounts are opened. So did you get declined? Like what happened essentially?
Okay.
It begs the question. So that's why I say you got to be really conscious when it comes to making those hard searches. Car finance, notorious.
Yeah.
You go into a
Is that
dealership.
what people do?
If you go into a dealership, those sales guys are telling you, oh yeah, we'll just check. By the time you get home, you got a hard search on your credit report and you're thinking, wait, I didn't even know if I like the car, let alone you guys now doing a hard search. So
Gosh.
car finance is notorious for. You got to put your foot down and understand the difference between the two.
Yeah.
So you don't get caught out.
That's crazy. So it makes sense with car finance, especially because obviously you're very excited. You're gonna give your details. You might have, they'll check it, whatever.
Yep.
Oh yeah, you can get it.
Yep.
And then you're like, nah.
Yeah.
But then your credit score's gone down because
exactly.
of that.
They're like,
mad.
oh yeah, we'll check to see what your rate's going to be. It looks like it's going to be this. Do you want me to do the check? And you're like, yeah, sure. Cool, I'll let you know tomorrow. Tomorrow comes.
Crazy.
Hard search. And you're like, well, I didn't even decide if I wanted the car yet.
Yeah.
But yeah, hard search. I speak to a lot of clients again with that situation where they're like, what's this search? They don't even know because they're not scrolling all the way down to the bottom of their credit report, because it's literally one of the last bits of your credit report searches. It's called footprint. So you've got soft search, hard searches, and then you've got like miscellaneous or audits. That's usually people just checking to see if you're still living at the same address and et cetera, et cetera. But soft searches, and then hard search, that's everywhere that you've made an application for credit. It's going to appear there. And it stays there. It's supposed to be 12 months. I'm seeing it last longer and longer now.
Really?
I'm seeing 18 months, 24 months before it's being taken off.
That's mad.
Yeah.
Okay, so we got to be careful. Let's not be too desperate trying to get too much car finance.
100%.
Let's not be too desperate trying to get every Amex.
Exactly. Like if you're going to make a decision for credit, make the decision, be firm in it, think, all right, okay, cool. I'm excited. Same with the 0% finance. Like I said, you're there in the moment thinking, I can either pay up front or I can actually take this out. Just take a minute, because the consideration, again, like I said, if you're someone that's going for a property, 3 months ago, this sounded like a great idea. Now your mortgage lender's now factoring that in terms of your affordability. And you're thinking, no, I'll just pay it off now. I'll just pay it off. So yeah, definitely make a firm decision and then commit to it when you're ready to. Not because some sales guy's like, I'll just run your details. So
I've got 2 questions about that, right?
Yeah.
Obviously, what if you failed your credit? Like say you wanted to get something, right?
Yeah.
If you failed, what should somebody do? Because normally they'll be like, okay, I'm going to try maybe somewhere else. I'm going to try in a month, right? I remember this when I used to work in a phone shop. This is what people would do, right? Come in, they fail the credit check.
Well.
Exactly. Fail a credit check, and then they'll try and come a little bit later, and I just tell them, look, you got to wait. I think at that time, we were telling them 3 months.
Yeah, something like that. Yeah. It's definitely the credit reports have got so much tighter since back then. And that's where I think a lot of the misconceptions came from. Like, my address is blacklisted, or they would try and change the details and etc. So back then, little things like that would work. But now with the use of open banking and all of the financial connections that we have, less so. So if you are declined for credit, I'm saying the first place that you need to go and check is your credit report. Okay. Absolutely. First place, sort of just get an understanding, get to grips on what your financial conduct or your credit conduct looks like. And the good thing is with the credit referencing agencies, not everyone wants to be paying a $14.99 subscription for their credit when they're not sure as and when they're going to apply for it. So I get that. But Experian, they offer a free service. TransUnion, Credit Karma, their app is brilliant. And Equifax, ClearScore. All of those are for free. So you're going to get reports. If you've got your notifications switched on, you're going to get reports sent to you regardless of whether you want it or not. Each month they're going to send you a report. They're going to notify you if something changes. I would say actually check your credit report before you go to make any application so you kind of know where you're at. And then the logic is if you get declined, okay, this one's a bit strict. Let me just leave those ones alone for now, especially like Amex, for example. Maybe Amex isn't for you. Maybe like Sainsbury's is more your lane at the moment if you need a credit card. Yeah. So
is there any way to not guarantee that you'll get something, but to not increase? You get what I mean?
I know what you're saying, but the apps have pre-approved data.
Yeah, that's it.
So so that's why I say check your credit before, because you can go down the pre-approved route and they'll tell you you're likely to be approved for 5 loans, and you'll go through the list and it will say 95% chance of you being approved for that loan. And they're doing that based on your credit, less so than your circumstances, because of course with your circumstances that's going to be income, how much your disposable income is, etc., living status, all of those sorts of things that will play a factor.
Yeah. Okay. Cool. So let's talk about the big boy stuff. Let's talk about what this is what the experts be doing, right? Because obviously they're using credit, right? We obviously we hear all these terms: credit line on business. Businesses use credit. Yeah. Truth, right?
100%.
My question for you is: how can you leverage the credit system to your advantage so that you're making money from it and not losing money from it?
What I say is that when it comes to your finances, try and manage your finances like it's a business. So for example, Q1, Q2, Q3, Q4. At the end of the day, everyone wants to make a profit. So if you've got savings, think of that as a profit. If you've got investments, if you've got equity, if you've got a high value net worth, that's your profit. If you have enough money to cover your expenses and you're not actively saving or investing, you're breaking even. And if you've got any form of debt, you're at a loss. So essentially what you want to be in a position to do, like with most businesses, is take a product or take a service and make a profit. Most businesses get investment right, Credit for you is your form of investment. So again, it's just about leveraging that investment to make sure that you're going to get a return. So for example, if it's going to be like what most people do actually, like for example with Airbnb, you might have taken out a £5,000 loan to renovate a property, for example, and you now rent out that property because you've now mapped out that within the following 3 months, you're going to get back, say, £10,000 based on the property being rented out. That's you leveraging credit because you didn't use any of your money. You only used £5,000 of another investment, but your return was £10,000. And you've done that, for example, in Q1. So you've done that in the space of 3 months. It's the same with properties and bridging. So you can actually buy properties without having to put any money down by using bridging finance, depending on how much bridging you need as well. Like I said, no money down. You're able to buy a property. You might already have a great credit card or a great loan, for example, or the bridging finance might account for what I'm saying is the renovation. Now you sell that property for even more money than what you bought it for. Yeah. You made 20 grand profit, but you made 20 grand profit without putting a finger in your pocket. But all you did was the hard work before, which is having great credit to get you in that position.
Yeah.
So essentially, that's why I say, look at your finance as a business and just think of credit as investment and how you can leverage that investment in which way to make money.
Yeah. And it goes back to what you were saying about the flexibility of that, because if you, like you say, if you have bad credit, you're not going to be in a position to do that.
You're not going to have the same options.
Right? You're not going to have the same options.
You're not going to have the same options.
Yeah, you're not going to have the flexibility. You're not going to be able to make more money, right? Yeah. Like you say, Airbnb, you get into a situation, like you say, you need to renovate. Well, you have to produce the cash yourself, right? Nobody's going to give it to you because they're like, well, I can't trust you. Are you going to be able to pay it back? Whereas if you have it, they'd be like, we can trust you. And then you're making money off that.
Off money, yeah.
Yeah, it's crazy. Another thing that a lot of people utilize, right, is obviously credit cards, right? But people, again, there's another level to it. There's some people that just use credit cards and they get into debt, unfortunately. But there's other people that utilize it for very specific things, right? To actually benefit from it. Can you talk about some of those? I think you mentioned a few, like you talked about like points and stuff like that. Can you talk about some of those types of credit cards and, what are the benefits of using them in that way? Yeah,
definitely. So you've got different types of credit cards. Most common ones, they'll call it credit builders. Essentially, it's just a credit card company throwing credit at you regardless of your circumstance. Yeah. And that's usually just, an available limit that you're able to sort of spend and take advantage of. But then you've got credit cards that will be a reward card.
Yeah.
And essentially that means that the more money you spend means the more points you earn, which can then transfer into rewards. So for example, air miles, if you've got it with a particular bank or a particular company. So for example, like Sainsbury's, they can transfer into say like Nectar points. Yeah. So essentially it's just, again, or the number of points that you get, for example, if you shop at certain retailers. Yeah. So it definitely makes sense to get a credit card that suits your needs and suits your lifestyle. And if you can be in a position, like think about it, 30k salary, sort of average taking home like just under £2,000 a month. Let's say, obviously irrespective of people's deductions, let's just say your outgoings every month is £1,200 and you got a credit card with a limit of 2,000. Or every month you can guarantee that if you spend on that credit card, you can pay it back in full because your outgoings are £1,200 regardless. Doesn't make a difference whether you spend it on the credit card or whether you spend it from your paycheck. But every month you're spending £1,200 on your credit card and you're getting back, for example, £3,000 worth of points that can then transfer into X number of miles. That might be a free holiday just for you literally utilizing your credit card for the same expenses that you would have covered from your paycheck. Just the bonus is that you've obviously got enough money coming from your paycheck that you clear your credit card in full every month. But as far as the credit card company is seeing it, you're really responsible. You're spending £1,200 every single month in, month out, and you're paying it back on time, never a day late. Yeah, let's reward her.
Yeah, exactly. And this is the thing. When you are strict, you're making money. You're getting a free holiday. You don't have to spend money on that holiday.
You don't have to spend money on that holiday. Yeah. Who doesn't want to get a free holiday, or who doesn't want to get cheaper flights or upgrade to premium economy or business class or etc.
Exactly.
So yeah, again, leveraging other people's money to to get something in return.
Yeah, you see, this is why I said it's the next level.
Yeah.
Because there's people doing it, like you say, they're spending the money anyway.
Yeah.
But just spend it through the credit card
Just
and I get the points.
spend it through the credit card. Exactly.
That's it, right?
If you know that you're in a position where there's a buffer, like, oh, okay, my outgoings are 1,500, but I still got a good £600, £700 clear. I've got an emergency fund, or I've got some savings, etc. Brilliant.
Yeah. So obviously banks, and you mentioned it as well, banks, you know, they want to make their money. They want to make their interest. That's what they're in the game of. They want to give us the credit card loans to make their interest, right? So what's the best way to obviously try and mitigate, you know, giving the banks interest? I know it's hard. It's easier said than done. But what's the best way to, like, you know, be like, yeah, I'm not giving you no interest?
When it comes to a credit card, essentially it's paying the balance in full.
Mm-hmm.
Now, you'll get 3 options when it comes to paying a credit card. So that is basically minimum payment, statement in full, or other, essentially. So the minimum payment is always going to be based on what the minimum payment is required for that particular month, plus a little bit of interest built in. And that's usually when, if people are in debt, they're seeing their balance sort of drop at the slowest possible rate. Statement in full now is literally where whatever the balance is. So like I said, if you've got an available limit of 2,000 and your balance is 1,750, if you select statement in full, it will clear the 1,750. It will take payment for the full amount and you're now back to zero. Other amount just basically means that you're in a position to choose. So the most logical is basically saying pay the statement in full. What I say to people as well is take note of when your statement is created. Because, for example, if your statement date or your payment date, let's say, because of when you took out the credit card or whatever, is the 5th of every month, and you get paid on the 28th. Now, the 28th to the 5th, that might be a long time if you're someone like what we just said, is utilizing their credit card every month and et cetera, et cetera. That's a good number of days that you can actually pay what you needed to pay and then go back to using the credit card again. And this is the trap that some people fall into, is that on the 5th, the statement is produced and they're thinking, but wait, there's a balance on there. Yeah, because the statement is created from everything from the 4th prior. You made your payment on the 28th. The 29th, the 30th, the 31st, 1st, 2nd, 3rd, 4th, all still to be taken into account. So if you spent on your credit card, it's going to show on your statement. And that's why a balance is carried over. Yeah. So pay attention to that statement date, because if you can make your payment as close to that date or pay in full as close to that date as you can, then it's likely that you're not going to carry anything over. And sometimes it just might mean, for those who, you know, might maybe get paid fortnightly or get paid weekly, yes, you might have a direct debit for X amount, but you know that, okay, right, by the following Friday that I'm due to get paid again, my statement's going to be produced at that time. Let me clear it in full. So again, the statement is showing zero, because it's the information on the statement that gets carried over to the credit referencing agencies.
Okay. So that's where you got to be very, very careful.
Yeah.
And obviously, talking about being careful, of course, if you don't do this correctly, you can put yourself in, like, you know, a real hole. So I guess, you know, and you can start earning a lot of money. Yeah. I guess on that question, then, on that topic, should I say, who shouldn't get a credit card or who shouldn't get a loan? I know we got to say some people can't do it. We got to demote some people, unfortunately. I'm sorry.
Yeah, some people got to get kicked out of the club.
Yeah, we got to kick them out until they're ready. You know, not everybody's ready for it.
No,
it's
they're not.
Be responsible.
If you're living beyond your means, a credit card is not for you. Bottom line, it's like what I said in terms of, you know, your finances being a business. So if you're breaking even every month, a credit card's not for you. Because where is the money coming from? Where's the buffer? Essentially, you know, there's no contingency plan. So breaking even is literally living hand to mouth, making ends meet. I personally don't think a credit card is for you. The reason why I say that is people will say, oh yeah, but what in the event of an emergency? Okay, but then where's the money coming from after the emergency?
Yeah.
If you're living, you know, hand to mouth, or you're breaking even, as I like to say, where is now the money coming from that you're going to now be in a position to pay that credit card back? And really and truly, you might have spent, say, £200, £300 on the credit card, but by the time you now pay that back over X number of months, because the credit card only wants a minimum payment of £10, you've now paid them back like £500. Was it worth it? It better you get in a position of being able to save up that £200 or £300, because that's what an emergency fund is for. Yeah. And anyone with any form of, you know, spontaneous, erratic, impulsive nature when it comes to finances, if you're someone that doesn't like checking your bank account, a credit card isn't for you.
Yeah,
And
I would
a
just
loan
say
isn't
stay,
for you.
definitely
Just
stay away from all that stuff.
Yeah.
Yeah.
Just stop.
Yeah, because
Stop.
you put yourself in a hole, and like you say, a credit card or loan should not be an emergency. That's madness.
Exactly.
That
But a
should
lot
not
of
be an
people have
emergency.
a credit card and will say, "Oh, but this is my emergency credit card." Huh? Why is the
That's
credit
the
card
emergency.
your
That's the emergency fund. The
That's
credit
their
card.
emergency fund. They'd rather not
Crazy.
save, but because they can get the credit card, because credit companies are throwing credit at
Yeah.
you, calling it a credit builder or X, Y, and Z. No, a £500 credit card is not an emergency credit card.
Yeah, that is the killer, and that's what's gonna really prevent your chances in the future if you want to get a property or anything like
Yeah,
that, right?
yeah.
If you're living like that on the edge, like
Yeah.
yeah.
Way
So,
too much.
Talking about discipline, how can you what tips do you have around people like staying disciplined with like if they do take out a loan or car finance or even a mortgage? We have to
Yeah.
be disciplined with all of these kind of things.
Yeah,
How do people stay disciplined?
I
like
think
that?
for me, it's financial planning, and not in the significant sense. It's literally planning ahead, setting goals,
Yeah.
and making sure that you apply consequences to goals. I think this is like applicable throughout anything in life. So, this is where I'm at. Again, planning your finances in the same way you would a business. This is the plan for Q1, Q2, Q3, Q4. This is the goal. And if I don't achieve this goal, this is then going to be the consequence on my life that I've set for myself. So again, like a mortgage, bottom line is, I've bought a property or I've got a property because I want to create generational wealth for my children, or I want to leave a legacy, or I want to become a property developer. Okay, that's the goal. So what that means is you're going to have to maintain that mortgage, because if you get a late payment on that mortgage, the whole plan that you had, scrap it, start again. You're going to have to pivot and go in a different direction, because the available funds that you thought you were going to have and X, Y, and Z, and the pool of lenders that you thought you was going to choose from and etc. is going to be completely different.
Yeah.
So what's the consequence? Again, like I said, if it's leaving generational wealth, it ain't really going to look exactly the same if, you can only go with 2 lenders and the interest rate is crazy. And this is the thing, people will complain at interest rates going up. But this is what happens in the economy when things like this happen. Interest rates go up. So it's not that, you secured a really good deal and now you're being hard done by.
Yeah.
That interest rate is set to fluctuate when the rate comes to an end, depending on what is happening with the economy. So even though you got a great rate 2 years ago, but you're at the end of your deal now, and this is what the state of the economy looks like. So now you're going to get a different deal, but you didn't factor that in. Now you're thinking you're hard done by. So the plan's looking a bit different. So that's why I say it's about what the long-term plan is.
Yeah, I love that. Let's talk a little bit more about the consequences of, obviously, like, let's say if you're fortunate enough to get credit, you got your mortgage, you got your credit card, you got your loan, whatever it is, right? You got your car repayment, right? Obviously, there's risks, right?
Yeah.
In missing these things. So, like, what's the consequences of if you miss a payment for any of these things?
So I like the 626 rule. So what that is everything stays on your credit report for 6 years. Just take that into consideration from either when you open the account or close the account. 2 years is if you miss a payment. That's going to be the impact that a missed payment can have. 2 years. So what that means is, going back to credit conduct, if you are actively applying for credit, lenders are going to be looking as far back as 2 years to see how you've managed your credit relationships, and will take that into consideration. Hence why a missed payment is going to impact you for 2 years. 6 years is if a missed payment then is significant enough where you continue to miss payments that it becomes a default, or like what we were talking about earlier, if it's just a straight closure of an account with an outstanding balance, it's a default. Again, stays on your credit report for 6 years. And in the extreme circumstances is then a CCJ. So that actually doesn't always need to be something that was on your credit report. That is just you owing money to someone somewhere, whether it was credit based or not. And again, a CCJ stays on your report for 6 years.
Yeah. CCJ, people are very shook of that one.
Yeah.
Right? Is it bad? Is it bad? Like,
You can get credit with CCJs on there. I think it's always easier to, use mortgages as an example. There are definitely lenders out there that have a remit to take into consideration a CCJ. Like if your CCJ is 10,000 and less, then we'll happily still accept the person, but they're now in category D because they've got a CCJ rather than a missed payment, which is like category A. But the impact of it is a big deal. And like I said, I don't want to pay another £700-800 on my mortgage because I could only go with this lender due to a CCJ because I ignored the paperwork. Because that's the reality is a CCJ, you get a form saying, I plan to take you to court.
Yeah.
Why did you think that they weren't going to take you to court?
Because people are shooketh. That's what it is, right? They're shook. They don't want to face it.
You're right. No,
they don't
you're
want to have the
absolutely right.
conversation,
Yeah.
Right. So it's like
facing sort of consequences when it comes to finances is definitely something that people sort of steer away from, shun from. And you know what the problem is as well? It's the embarrassment. You know, if I've got a CCJ and you sound like you're in good financial standing, I don't want to tell you that I've now got a CCJ, even though I genuinely need help in how to deal with it. So this is something that I work with clients a lot in terms of getting their CCJs removed or working with them through their credit report, because CCJs can actually be removed.
Okay, cool. How's that?
Not every CCJ is fair. Now the debt might be fair.
Okay, the debt might be fair.
People don't confuse me. The debt might be fair, but the CCJ itself, the county court judgment, you can argue. So the route that you want to go down essentially is, first, obviously, you want to check your credit report. You want to get the reference of that CCJ, and then you want to call up whichever court gave you the CCJ, most time Northampton County Court. Give them a call. They'll give you all of the information. So they'll say, right, this company gave you the CCJ. This is the set of solicitors or company acting on their behalf, and these are the contact details. It can be something as simple as a parking ticket, which is really common. You park on private land is definitely going to slap you with a CCJ. But suppose you've moved address 6 times and they've sent it to your old address, or when you were still living with your mum and dad or whatever. You didn't get any paperwork. So why is it fair that you be issued a CCJ when you're none the wiser of the information for you to fight the CCJ? So like I said, it's not about admission of the debt. The debt, you might genuinely owe the debt, but it's about you being in receipt of the CCJ. And so what you want to file is an N244. So that's the application. It's the application that the courts will give you. You have to pay for it. It's £275, but you'll file that application. And like I said, it's not about admission of the debt. It's about why the CCJ is unfair.
Okay.
If you can prove that the why you got it was unfair, they'll remove the CCJ from your account.
Okay.
Like I said, 6 years statute of limitations. So what that means is they can't now come back for you and apply a CCJ, providing you still meet the terms of that debt. So it kind of allows you to now enter into an agreement if you owe it, put in place a payment plan, whatever it is. So, but it's all about the debt.
Yeah.
So yeah, that's help that I give my clients as well. A lot of people are just like, that just sounds way too complicated. Just deal with it for me. But these are the things that you got to know, because many people
know it,
many people are out here suffering with CCJs, and it's like, I didn't even live at this address. I didn't get any of the paperwork.
And this is why you shouldn't be scared. No, you can be scared, but talk to somebody about it.
Someone.
Because you could have been living in fear, and now you've now heard on this podcast, I could have got rid of it.
100%.
You've got to try things.
Yeah, and you might not have even got it. The debt might have only been something like £150, but because you didn't want to open the post or whatever, you probably got the claim form which said respond in 30 days, because they have to send you that notice.
Yeah.
If you responded in 30 days and paid the £150, no CCJ. But because you ignored it, and this is what I mean, debts follow you. They will follow you somewhere. Even if it's not to your home address, they will follow you on your credit report.
Yeah, it's mad. So obviously some people might be listening to this podcast being like, I don't want to deal with this hassle. Right? This is long. I'm not getting credit at all. Nah, I'm just going to avoid it, right? I guess, what's your thoughts on that? Because obviously people will be scared, right? They don't want to, maybe they're not sure, maybe I'll miss a payment, maybe I'll miss a default. They've heard these stories, right?
Yep.
I guess, what's your thoughts on that?
I think it's fair. Like I said, credit is subjective. So it's absolutely fair to say, that's it, I'm going to completely stay away. I'm not going to borrow anyone else's money and etc. But like I said, credit is about being able to pivot your financial situation. It's a lot quicker to get £5,000 tomorrow than it is to save up £5,000 from your paycheck. So again, if the credit makes sense for your financial plan, then go for it. If buying a property is within that plan and you want to save up the 300,000, the 400,000, or depending on what part of the country you live, all of that money, because you're, that headstrong that you don't want any credit, then I wish you luck. If you can do everything without credit, then you're much better off financially than I am.
For real. Whoever that superstar is,
that's what I'm saying.
Shout me.
Yeah.
All right. So let's talk about tips to improve your credit score. What 3 things that somebody can do to improve like their credit score and their credit conduct?
Okay, so credit conduct is definitely having everything automated. So every single account that appears on your credit report, have it paid by direct debit. So the money can just leave your account. You don't even have to think about it. That avoids things like missed payments, etc. The next thing is that if you do have any outstanding debt, now there's going to be loads of sort of comparative information online in terms of whether it should be 50%, 40%, 20%, 0%. But if you've got any debt, especially when it comes to things like credit cards and loans, you want to get your utilization as a first ballpark place, 40% and less. Because anything that's 50% and above makes it look as if you're relying on credit. So if it's 40% and below, you're no longer relying on credit. It obviously, your credit report and your score will improve as that amount gets less and less. But like I said, if you're in debt, that's where you kind of want to head to first and foremost. And then B, just getting into the habit of definitely checking your credit report. Like I said, minimizing the applications, not relying on credit, and etc. So just knowing all of the information that's within your credit report.
Love that. It's been such an amazing conversation. I wanted to talk, obviously, like you said, you're an insurance specialist. I wanted to talk a little bit about, the gender gap around that, right?
Okay.
So obviously, I think when we spoke, you were telling me that less women protect themselves, right? With insurance.
Absolutely.
Is that true, right?
Yeah, it's true.
So talk to me about that. Why is that happening?
Okay, so when it comes to, let's just take the most common one. So only around 38% of adults in the UK have life insurance.
That's low, yeah.
35% of that figure is women.
Oh, wow.
Only 35 have life insurance. That figure drops to only 18% when it comes to a critical illness policy, and it drops to 11% when it comes to income protection. And I think it's just because of the role that women believe they play financially. So if you take, say, a 2-income household, take a family, let's say, first and foremost, you should 100%, you should have some form of insurance if you're raising children. I'm just using children as an easy example because ultimately you're both the child's parents, and it costs 180,000 according to the government. I think it's more, but it costs 180,000 to raise a child until the age of 18. If you don't have 180,000 pounds in the bank as of now, then that means if anything happens to one of you tomorrow, how are you going to be able to financially afford bringing up that child on your own? Now, if you take the consideration of mothers being stay-at-home mothers, there's nothing tangible when it comes to, from a monetary value, that they see when it comes to the role that they play. Bottom line is the other partner, for example, is bringing home, I don't know, let's say a 50k salary. It's £3,000 a month, give or take. That's paying for the rent, the mortgage, food, gas, electricity, etc. So financially, what role does the mother play? It's really hard to sort of decipher that monetary value. But the truth is nursery costs, childcare costs, her mental state of health costs, the stimulation of the child, etc. It does have a monetary value. So if you take the mother away from that situation, or the stay-at-home parent, let's say, because regardless of the sex, but if you take a stay-at-home parent away from that situation, the breadwinner now either is going to have to work less because they've got to take care of the child, or they're going to have to work more to afford childcare.
Yeah, 100. Yeah.
So now when you apply that to mothers or women who are seeing the role that they, or the value that they bring to the table as less, this is the problem. Why am I now going to fork out another expense when my income doesn't stack up or my income doesn't hold as much weight? Absolutely not. It's not about the income value. It's about the role that you physically play when it comes to your finances. And I think obviously when you think of things like the pension gap, the investment gap, or etc., women are far more risk adverse. They're obviously just not getting paid as much. They're not in a position to contribute as much. So again, to now have to sacrifice another direct debit, there's always a misconception that insurance is far more expensive than what it is. To sacrifice another direct debit when you've got someone else that's earning more, or you're just trying to get to a place of, equity, let alone
100
from being back there. Insurance is like the last thing that you're then going to consider, when in actual fact I think it should be one of the first.
So talk to us about why it's important then for obviously women, given that there's that huge gap, and 80%, 11% is low.
11% for income protection.
35. Did you say 35%?
35% of UK adults have insurance. 38% of that 35 is women.
That's low.
Low.
Yeah. So,
if you think about it.
Talk about the importance of that, right? Of women protecting protecting themselves, especially like I'm thinking, because I know you talk a lot about income protection. I'm thinking income protection,
100%.
right? Because a lot of women these days are still working.
100%.
It's not like they're not working. Right?
Working longer than what they used to.
Exactly.
There's data saying that actually come by. I think AXA released a report and Royal London released a report beforehand that actually said women are going to be the sole breadwinners of households. They're going to make up 25% of them come 20 to 30.
Wow.
So at the end of the day, if your income is important to you, then you need to have an income protection policy. Yeah. And if you think of women as well, even just from a childbirth perspective, whether you plan on having kids or not, you know, especially as a black woman, when you're in a position where you're 5 times more likely to die from something like childbirth, we ain't even had the baby yet and we're at risk. Do you know what I mean? So at the end of the day, there needs to be some form of insurance in place that just means that your affairs are in order. And I think especially as women, if we're saying that we want equity, not equality, but we're saying we want equity, which is men and women are paid the same, then we also have the responsibilities to start viewing our finances the same. Mm-hmm. If we're being more independent, like I said, we're now becoming more breadwinners than ever before. We're managing our finances more. We're buying properties more on our own. Then we have to take control of our finances and put in place protection. Protection is the contingency plan that you didn't have to save up or work hard for. So yeah, I think it's an absolute imperative.
Yeah. Love that. Love that. Yes, Ella, thank you. It's been such a great conversation. It's been good to catch up with you. Like, nearly 3. I feel like it's not 3 years too late, but we should have done it like a little bit sooner. But I'm glad that we still did it. Yeah, I'm still glad that we did. It's been a great conversation. Like I said, I've learned a lot from you in terms of, you know, credit, and also I think insurance again is very important. I'm glad that we're speaking about the gap, because I think it's very, very important for us to protect ourselves. It's very, very important for us to, again, on the credit side, for us to just be mindful of these things. We just got to plan every aspect of it. So it's always good to like chop it up with you and have these kind of conversations. Yeah. And you're dropping gems and insights. If people want to connect with you, where can they find you?
So Instagram, all social media handles, Ella Insures, LinkedIn, Ella Weinberg, and then online, www.ellainsures.co.uk.
Amazing. Like I said, it's been great. We can definitely do a part 3 I'm here for it. In the future. Like
Not another 3 years though.
No, we won't wait 3 years. You know what's so funny? People are gonna go back and watch that episode, because that episode at that time, when my numbers then did well, actually.
Yeah.
Like, not surprisingly, it was great. It was great. Yeah. And I think your perspective on insurance was like a very good way. It kind of got us to think in a different way. And I think you've done that again with like credit today. Okay. I like the fact that you said that, like, think of yourself as a business. Like, I love that. Yeah. I absolutely love that. Like you were saying, like, you're breaking even if you're not. Yeah. If you're not coming in, you're not going with your money, you're not saving more, but you're just like, you know, just getting by your break even. I love that. And I think it's a good way to think about these stuff. Because if you contextualize it in that way, you're going to make smart decisions. Yeah,
100%.
Right?
Yeah, everyone wants a successful business. So then when you put it in perspective, it's like, oh, okay. Yeah, let me make some changes.
It's mad. So do you have any final words for the watchers and listeners?
Oh, gosh, now you put me on the spot.
I don't really say that.
Well, if you're a woman, contact me. Let's sort out some insurance. If you're a guy, I guess it's the same message. But yeah, I think for anyone, just not to underestimate the importance of planning when it comes to your finances. You don't necessarily need a financial advisor to plan. You just need to be able to assess and take accountability for where you're at, understand where you're trying to get to, and fill in the gaps in between. And if there's any gaps that you can't fill in, that's where you get help.
Love that, Anna. Thank you so much.
You're welcome.
Great to have you again on the podcast. Thanks so much for tuning into this episode of the podcast, and see you next week's episode.